Imagine inheriting a fortune only to ditch your parents' trusted financial advisor. It happens more often than you think. A staggering amount of wealth, projected to be over $120 trillion, will change hands in the next 25 years. But here's the kicker. Most heirs aren't sticking with their parents' advisors. Why is this happening, and what does it mean for the future of wealth management? According to research by Cerulli Associates, a mere 27% of beneficiaries, primarily widows and children, intend to keep their benefactor's wealth advisor. This data comes from a survey of investors who hold at least $250,000 in financial assets. And it gets even more interesting. The percentage drops to just 20% among those who have already inherited their wealth. That's a significant shift. This suggests that the initial loyalty or sense of obligation fades once the reality of managing the inheritance sets in. But here's where it gets controversial. Is it really about loyalty, or is it about finding the best fit for their financial future? Now, you might assume that these heirs are rushing off to dabble in self-directed investing or explore the latest digital finance platforms. And while some might be, that's not the primary reason. The survey reveals that half of the heirs who switched advisors already had their own established financial professional. Think about it. Many inheritors are middle-aged adults with existing financial plans and trusted advisors. Receiving an inheritance simply means adding to their existing portfolio, not necessarily overhauling their entire financial strategy. The second most common reason, cited by 28% of respondents, was simply not having a relationship with their benefactor's advisor. This highlights the importance of building rapport and trust, and this is the part most people miss. A lack of personal connection can be a deal-breaker, regardless of the advisor's track record. Only a small fraction, 14%, expressed a general aversion to working with financial advisors at all. And 10% felt that the existing advisor didn't align with their specific investment needs. It's also important to note that respondents could select multiple reasons, indicating that the decision to switch advisors is often multifaceted. John McKenna, a research analyst at Cerulli, offers a valuable perspective. Keep in mind, if the parents die in their 70s or 80s, the inheritor is between 40 and 60. In most of these cases, they have matured into wealth management clients. They have relationships, and they're just going to be adding incrementally to their existing relationships rather than starting a new one with a legacy advisor. This underscores the point that inheritance often occurs later in life, when individuals already have established financial habits and preferences. Interestingly, benefactors themselves seem surprisingly unconcerned about whether their heirs retain their advisors, despite generally reporting satisfaction with the service they receive. Cerulli's research shows that while just over a quarter of benefactors expressed a desire for their heirs to continue the relationship, more than half were either unsure or explicitly stated that the decision was up to the beneficiaries. A small minority, 7%, actively didn't want their heirs to use their advisor, primarily because the parties lacked an existing relationship. This highlights a potential disconnect between the benefactor's assumptions and the heir's actual needs and preferences. The real issue, according to Scott Smith, Senior Director of Advice Relationships at Cerulli, often boils down to a lack of communication. He points out that clients frequently hesitate to discuss their estate plans with their families. Shockingly, even among investors with over $5 million in financial assets, 20% admitted they intended for their heirs to learn about their wealth after their death. And the actual number of procrastinators is likely even higher, as 34% of high net worth heirs reported receiving this information only after their benefactor passed away. This reluctance to engage in these crucial conversations can create significant challenges for both heirs and advisors. Benefactors believe that they will talk to their next generation about this stuff before they die, Smith explains. But when we ask the next generation, these conversations didn't happen. This communication gap prevents advisors from building relationships with potential future clients and understanding their individual financial goals and concerns. As a result, advisors miss out on valuable opportunities to connect with their clients' children and demonstrate the value they can provide. Smith emphasizes that it's the advisor's responsibility to encourage clients to overcome their reluctance and initiate these uncomfortable but essential discussions. He advises advisors to reinforce it with the primary contact that it's important for the survivor to get involved early on so they have their feet securely on the ground and they aren't panicking as soon as it happens. It's not just that we're trying to retain the assets. We're trying to make it easier for your survivor when you pass. The ultimate goal should be to provide a smooth and supportive transition for the heirs, ensuring they are well equipped to manage their inheritance responsibly. This goes beyond simply retaining assets. It's about providing peace of mind and financial security during a potentially challenging time. So, what are your thoughts? Should wealth advisors be more proactive in engaging with the next generation of inheritors? Or is it ultimately the benefactor's responsibility to facilitate these conversations? And is there a point where an heir should feel obligated to continue working with their parent's advisor, even if it's not the best fit for them? Share your opinions in the comments below.